Hey, what's up, guys? It's Ezekiel Chiu here. So, everyone is talking about the smart money concepts or the ICT, right? It's like, ooh, you got to learn the smart money concept. This is how the market works. If not, you're going to lose money. Some of the teachings are true, but most would actually do you more bad than good. So, in this video, I'm going to point you to the exact key things that you should know about the smart money concept and how to actually use it to make money in trading. Okay, so first off, in order for you to know what is the smart money concept, let's start by introducing this term, inducement. So, what is inducement? Right, so inducement happens at a key level or a zone where traders, they believe it is the ideal entry point based on their analysis or the strategy itself. Large, say, financial institutions, the central banks, right? They often use this tactic to lure the retail traders like us into all these liquidity traps. Now that we have identified the term inducement, so the question is like, where does it happen on the chart itself? Where can we find all these inducements? So I'm going to show you the 4 most common spots of inducements. Okay, number 1, order blocks. So an order block is an inducement level where traders, they like to place their buy or sell orders over there, right? And they often get drawn into the market in that location only to be trapped. So take a look at this, right? What happens is that price breaks the recent market structure to the upside, right? And it forms what? It forms this bullish order block. So, and that is where traders like to place their buy orders, expecting what? Price to reject over there and bounces back up, right? So taking a long position at that very spot. Now, this area, it acts as an inducement zone, right? So you see in this case, and also multiple cases, you're gonna see that price fails to respect this bullish order block, right? And it makes this order block invalid, right? So it's causing SMC traders, right? Smart money concept traders, to lose their trade because like I said, there's so much hype over all these order blocks, right? They're gonna cause them to lose their trades. And it's where all these SMC traders are taught to trade at, right? Identify the order blocks, enter over there, right? So that itself is an inducement area. The second common spot of inducement, that is support and resistance. So support and resistance is a classic level, right? Where traders, they often get induced without even realizing it. So as you know, what happens is that traders, they see support and resistance levels where price changes direction, right? So, and it's very easy to get induced to want to enter at these spots. So for example, you see, the base area is a major support zone, right? And it's so strong is because it has rejected price multiple times. And this would induce traders what? To enter into the market itself, right? So the traders get induced into the market every time price returns to this area, right? And they hope for what? They hope for price to bounce back up, an upwards movement, right? So then they place their buy orders over there, and then what happens? It gets them trapped in the market itself. So if you take a look at this, before the market moves upwards, price actually went down with this big long wick, right? It hits the stop loss of traders who had actually placed buy orders at the support level itself, right? So then what happens next, right? Price, after taking out all those buyers, it then shot its way back upwards. So this is an inducement. And you're gonna see, like, if you have been trading a while, you're gonna see that multiple times trades like that is gonna come down, stop you out, and then the market goes back up in the intended direction, only to get these traders like, oh, damn. They're like,
hey, you predicted that trade, right? And it went up.
Yes.
So did you win?
No, I actually got stop out.
why? Because this is an inducement level. Number 3, the swing highs and the swing lows. All right, so take a look at this, right? On the daily time frame, right, we have this swing high as the highest point that price has recently went up to. Okay, now we also identify this low as the swing low. So what most traders would do is that they will place their buy and sell orders, right? The buy at the swing low and sell orders at the swing high itself, right? So with the belief that price is going to respect these levels and reverse, right, in the direction upon reaching them. So now take a look at this. This is what is going to happen, and it's going to happen a lot of times. And this is what kills a lot of traders. And this is also the reason why 90% of the traders out there, they don't make money. Because it's like, hey, Ezekiel, I learned to enter at support resistance level. I learned to enter at all this level, but I always get stopped out. Because these are inducement levels, right? So if you take a look at this, price creates a fake out at the swing low and the swing high, right? And obviously with all this fakes out, what happens? It hits the stop loss of both the buyers at the bottom and the sellers at the top itself, right? So these are inducements, right? Now, obviously, there are ways to go about it, right? But the key now is for you to understand firstly that if you place, say, a pending order at all these levels, right? Or you just, okay, I'm going to buy there, right? Or I'm going to sell there. I'm just going to do that blindly. With a stop loss that is just right above it or just right below it, you are likely going to get stop out like super easily, only to see the trade going back into your intended direction. The 4th most common spot of inducements, trend line. All right, so now let's see how they play into all these inducement setups. A trend line is what? It connects the what? The lower highs, right? To show the lower highs or the higher lows in the uptrend, right? To show the price direction, right? And that represents like the support, like a support or resistance in that direction. So retail traders, they often use trend lines as entry points, and they react to it when price touches it and then come back down, for example, right? Or breaking through them as breakout trades, right? So now, take a look at this. This trend line is plotted using the lower highs, right? And it has been touched twice, right? So this prompts retail traders, right, to take potentially short positions, selling trades, right, after price respect the trend line itself. So now, on its, you can only plot the trend line with 2 touches, right? So now, on the 3rd touch itself, traders may go for a short position, right? If price respects the trend line, or they go for a long position if it breaks through the trend line, right? So they're going to do this pattern based on their analysis and maybe based on the strategies if it meets this pattern, right? So this trend line is an area of inducement. All right, so now that you got the idea of what an inducement is and where can they be found, I'm going to cover one more important concept first before I put it all together. All right, this is called liquidity. Where can we find liquidity? Liquidity zones can be found at several areas. They can be found, for example, below equal lows. Equal lows means the same level. A low, equal lows, right? They can be found below individual swing lows, right? They can be found above equal highs or swing highs. They can be found below or above trend lines as well, or channels, right? And also below or above order blocks itself. Okay, so now take a look at this. Here are the two lows at the base, right? Here are the two lows. So this is the major support level, right? It's a major support level. It is also a swing low level, right? This is also a swing low level. And they are also equal lows, right? So liquidity zone can be found below it, right? So the same thing as goes for right at the top. Right at the top is the swing high. So liquidity zones are above it. All right, now if we look next, you can see a high and the next high on the right. So those are the equal highs. And those above it is the liquidity zone. And then slightly below are two equal highs as well. And that is also above it is the liquidity zone, right? Now, we can also draw trend lines, right? Like all the lower highs above the trend lines are liquidity zones. And on the other side, below the trend lines are liquidity zones. Right now, if you look on the left, you're going to see the order blocks, right? Marking all the lows. Individual lows would mark the order block, right? When it's making higher highs, right? Those are the order block once there's a break of structure. Order blocks, when priced below the order block, are liquidity lows as well. Are liquidity points as well. All right, so there you go, right? So now you know where are the liquidity zones found. This is where I'm going to start putting it all together. I'm going to show you how to use inducement and liquidity into your trading plan itself, so that you can avoid getting trapped by the market makers and reduce your potential losses, right? As you can see in this illustration over here, we have a downtrend, right? So what happens is that price mitigates the zone here, right? And then reverse to the downside. So if you take a look at it, is pushed lower, but it fails to break the recent structure. It fails to break the recent low itself. Okay, so then what? Price makes a tiny pullback to the upside after gaining momentum, right? And then price is now pushed to the downside and officially make this break of structure over here. Okay, now, so here's what happens. We have at the top over here this unmitigated zone, which price hasn't touched before, right? Where price may potentially reverse from, after which. All right, so now we also have another unmitigated zone here. Unmitigated zone, right? Which is caused by what? The recent break of structure, because it broke the structure, right? So that itself, it's also a zone. So this is going to confuse traders, right? And all these inducement areas are set and in a way created by the players, right? Like the banks, like the trading institutions who have big money, to deceive retail traders and to build liquidity. Okay, so for us, this zone is an inducement level, right? It's going to induce you to go there, right? So price tried to what? To mitigate the upper zone, but couldn't, right? But drop quickly and then break the structure itself. So market makers would use this to induce ICT, right? And retail traders to what? To enter sell positions here. All right, so now take a look. Here's what happened. Price now, after breaking the structure, price rises, right? Touches that inducement zone. And we see a little rejection. So this would get like traders, excited. right? And thinking like, okay, the price is about to move in their direction itself. Right now, as you can see here, like I said, this scenario is set up by market makers, right? And it has generated a lot of liquidity, right? Just below our first, the upper one, unmitigated zone. All right, so now, as you also know, the market always what? It got to sweep the liquidity to gain momentum. So, price comes back to our first unmitigated zone and sweeps the liquidity there. All right. After sweeping the liquidity there, so it got all those traders who entered at the inducement level get stopped out, right? They get stopped up, it sweeps the liquidity, it goes up to sweep the liquidity, and then it officially continues its primary direction downwards. So if you take a look at this, this is such a tricky chart itself. All right, this is such a tricky chart itself, but it happens all the time. Right? Or I would say it happens frequently enough. All right? So this is how, in general, one of the examples of how market makers, they manipulate the market. All right? They trap the traders thinking that, all right, that is the zone, right? And then take their capital off to gather liquidity. Okay? So the key motive of understanding smart money concepts or ICT is to know, all right, where all these potential traps are, right? Like the one that we just seen, right? But here's the thing. Not all inducement areas are traps. Some, not all of them. But it is still good to know the likely spots, right? The likely spots, like the ones that I showed you, so that you can prepare to avoid them, such as the recent one that I showed you just now, right? Because they're so close to each other. So, say if you entered at an inducement area, right? And then, like what we've seen, you enter inducement area, price went up, you get stopped out the first time. You enter inducement area, price went up, you get stopped out, right? And then it goes to the upper zone, right? Now, when it comes back down after hitting the next unmitigated zone, right, which is what you've seen, and it comes back down, this is a good chance that this is now the real move where you can enter again, right? Provided that this is part of your trading setup. You got to backtest this, right? You got to backtest this to make sure that this is part of trading setup, right? And the risk to reward ratio of this trade is also good, right? Such that it can cover your first loss that you have taken. All right? So, smart money concept and ICT is to make you aware of such inducement zones, right? And also the liquidity areas, right? It may sound a bit advanced, but it's good for you to understand the overall concept behind it. There are market makers before, now, and after, right? The key for us is to understand how the market works. Now, do they manipulate the market all the time? Which is why if you blindly just say that, oh, it's an inducement level, I'm not going to enter, then you're going to miss a lot of trades. So no. There will be times where this area that seems to be inducement areas is still going to work, right? So you don't just like, oh, this is an inducement zone, I'm not going to enter. No. So what do we do? Right, first off, you want to enter trades with high probability. Then you don't just want to enter with just one reason, right? You identify an area of value, right? You identify an area of value, which is I covered a lot in my other videos. That's one area of high probability. Then you want to add extra confirmation. For example, like multiple time frame confluence. You want to enter with candlestick confirmation. You can enter with break of structure in the lower time frames, right, etc. So, for example, I covered all this in the video called Forex Trading Strategy, right? So you also only want to enter trades that are part of a successful back-tested system. It's like you don't just want to watch a video on YouTube like, oh, I learned this strategy, I'm going to apply this on my next live trade without back-testing it. No, it's not going to work that way. All right, so you gotta test that trade over a series of period, over a particular pair. Only when it's successful, then you put it live. So that's when you know that, hey, if you keep taking this similar kind of trade setups and you're going to win before, it's likely that you were going to win in the long run itself. All right. So now, because you now understand smart money concept as a whole, right, and now you know where the liquidity spots are, or where is the next unmitigated zone, right? This will now allow you to know potentially when and where to place your entry and your stop loss to avoid also getting stopped out easily. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.